The previous video covered how debt works as a tool and how to pay it down strategically. This video covers what happens when debt stops being a tool and starts being a trap. Not all debt is created equal, and some financial products are specifically structured in ways that make them extremely difficult to escape once you are inside them. Understanding how these products work, what the consequences of unmanaged debt look like at their most serious, and how to recognize and exit a debt trap before it causes lasting damage is some of the most practically important information in this entire course. A debt trap is any debt situation in which the structure of the product, the interest rate, the fee schedule, or the repayment terms makes it functionally difficult to reduce the principal balance, resulting in a cycle where payments are made indefinitely without meaningful progress toward payoff. The defining feature of a debt trap is not the amount of money owed. It is the ratio between the cost of carrying the debt and the borrower's ability to make meaningful payments against the principal. When the interest and fees accumulating on a balance each month approach or exceed what the borrower can afford to pay, the balance grows rather than shrinks regardless of how consistently payments are made. That dynamic is what makes certain financial products predatory by design rather than by accident. Payday loans are the most widely documented example of predatory lending in the United States. A payday loan is a short-term, small-dollar loan, typically between $100 and $1,000, designed to be repaid in full on the borrower's next payday, usually within 2 to 4 weeks. The fees charged on payday loans are expressed as a flat dollar amount per $100 borrowed rather than as an APR, which obscures the true cost. A typical fee of $15 per $100 borrowed on a 2-week loan translates to an APR of approximately 390%. On a $400 loan, you owe $460 in 2 weeks. That structure is manageable if the loan is genuinely a one-time bridge between paychecks. The problem is that most payday loan borrowers cannot repay the full amount plus fees on their next payday without creating a shortfall that requires another payday loan the following cycle. The Consumer Financial Protection Bureau has found that the majority of payday loan revenue comes from borrowers who take out 10 or more loans per year, meaning the product is sustained not by one-time emergency use, but by recurring debt cycles among people who cannot exit. The rollover mechanism is how the cycle perpetuates. When a borrower cannot repay a payday loan in full on the due date, many lenders offer a rollover, which extends the loan for another pay period in exchange for paying the fee again. A $400 loan at a $15 per 100 fee costs $60 to roll over for 2 more weeks. If this happens repeatedly, the borrower can pay several times the original loan amount in fees without reducing the principal at all. Some states have passed regulations limiting rollovers or capping payday loan fees, but the industry remains largely accessible in many parts of the country, and online payday lenders operate across state lines in ways that complicate regulatory enforcement. Rent-to-own arrangements are another form of predatory financial product that deserves attention. Rent-to-own stores offer furniture, electronics, and appliances on a weekly or monthly payment plan with the option to eventually own the item. The weekly payment amounts appear modest, but the total cost of completing the agreement, when annualized, typically represents an effective APR in the range of 100 to 300%. A television with a retail value of $400 might cost over $1,000 to own through a rent-to-own arrangement completed over its full term. The product is designed to attract buyers who cannot afford the upfront purchase price, but the total cost is multiples of what the item would cost purchased outright or even financed through a standard personal loan. High-interest credit card cycles represent a third category of debt trap, one that is less obviously predatory in structure but functionally similar in outcome for many borrowers. Credit cards with APRs in the range of 25 to 30%, carrying balances that are maintained through minimum payments, can generate a cycle where the minimum payment covers little beyond the monthly interest charge. The balance does not decrease meaningfully, and the interest continues to compound. Unlike payday loans, which are structurally short-term, credit card debt can persist for years or decades when managed exclusively through minimum payments. The trap is not a single transaction, but a behavioral pattern, minimum payment reliance combined with continued card use, that sustains and grows the balance over time. Understanding what happens when debt goes seriously unpaid is important because the consequences are progressive and increasingly severe the longer the situation is unaddressed. The first stage is delinquency. A debt becomes delinquent when a payment is missed. Most lenders have a grace period of a few days beyond the due date before a payment is officially reported as late, but once a payment is 30 days past due, it is typically reported to the credit bureaus as a late payment. A 30-day late payment causes a significant drop in credit score, and the damage increases as the delinquency ages to 60 days, 90 days, and beyond. If a debt remains unpaid for an extended period, typically 120 to 180 days, depending on the creditor, the original creditor may charge off the account. A charge-off means the creditor has written the debt off as a loss for accounting purposes. This does not mean the debt is forgiven. It means the creditor has stopped expecting repayment and has classified the account as a loss. Charge-offs are reported to the credit bureaus and cause severe credit score damage. After a charge-off, the creditor may attempt to collect the remaining balance themselves, or they may sell the debt to a third-party debt collector for a fraction of the original amount. Debt collectors are companies that purchase delinquent accounts from original creditors and attempt to recover the balance. The debt collection industry is governed by the Fair Debt Collection Practices Act, commonly called the FDCPA, which establishes specific rules about how collectors may contact debtors and what practices are prohibited. Collectors may contact you by phone, mail, and in some cases electronically, but they may not call before 8 in the morning or after 9 at night, may not use abusive or deceptive tactics, must provide written verification of the debt upon request, and must cease contact if you submit a written request asking them to stop. Knowing these rights is important because debt collection can be an intimidating experience, and collectors sometimes use tactics that exceed what the law permits. If a debt collector or original creditor decides to pursue legal action to recover an unpaid debt, they can file a lawsuit in civil court. If they obtain a judgment against you, meaning the court rules in their favor, they gain legal tools to collect the debt that they did not previously have. One of the most significant of these tools is wage garnishment. Wage garnishment is a court-ordered process in which a portion of your paycheck is withheld by your employer and paid directly to the creditor before you receive it. Federal law limits garnishment to a maximum of 25% of your disposable earnings, or the amount by which your weekly disposable earnings exceed 30 times the federal minimum wage, whichever is less. Some types of income, including Social Security benefits and certain other federal benefits, are exempt from garnishment. Wage garnishment is a significant escalation because it removes your control over a portion of your income entirely. Bank account levies are another tool available to creditors who have obtained a court judgment. A levy allows the creditor to instruct your bank to freeze and transfer funds from your account to satisfy the judgment. Unlike garnishment, which is applied to future income, a levy is applied to existing account balances. Receiving a notice of a bank levy can result in checks bouncing and automatic payments failing, compounding the financial disruption. Bankruptcy is the legal process available to individuals whose debt load has become genuinely unmanageable. It is a federal process governed by the United States Bankruptcy Code and provides either a restructuring of debt repayment or a discharge of certain debts, depending on the chapter filed. Chapter 7 bankruptcy involves the liquidation of non-exempt assets to pay creditors, followed by the discharge of most remaining unsecured debt. The entire process typically takes 3 to 6 months. Chapter 13 bankruptcy involves a 3 to 5 year court-supervised repayment plan, after which remaining eligible debts are discharged. Bankruptcy stops most collection actions immediately through an automatic stay and provides a legal resolution to debt that has become impossible to manage. The credit consequences are severe, with bankruptcy remaining on the credit report for 7 years for Chapter 13 and 10 years for Chapter 7. And its use should be considered only after consultation with a bankruptcy attorney when other options have been exhausted. Recognizing a debt trap early and taking action before the consequences escalate is significantly less damaging than waiting until the situation has progressed to collection or legal action. If you find yourself in a situation where debt payments are consuming an unsustainable portion of your income, there are several options worth pursuing before the debt becomes severely delinquent. Contacting the original creditor directly and requesting a hardship arrangement is often more productive than most people expect. Many lenders have internal programs that allow them to temporarily reduce interest rates, waive fees, or establish modified payment plans for borrowers experiencing genuine financial difficulty. These programs are not widely advertised, but they exist because a modified payment arrangement is generally preferable to the creditor compared to a charge-off or the cost of legal collection. Nonprofit credit counseling agencies offer free or low-cost debt management assistance and can negotiate with creditors on your behalf to establish consolidated payment plans at reduced interest rates. The National Foundation for Credit Counseling is a reputable source for locating legitimate nonprofit counseling services. Debt settlement, which involves negotiating a lump sum payment for less than the full balance owed, is a separate option with significant risks and tax implications that warrants careful evaluation before pursuing. The earlier you address a debt problem, the more options you have available and the less damage accumulates. The progression from delinquency to charge-off to collection to legal judgment does not happen overnight. At each stage, there are intervention points where the situation can be stabilized and a path forward established. What allows problems to reach the most severe stages is typically a combination of avoidance, lack of awareness about available options, and the understandable but counterproductive tendency to stop opening mail and answering calls when financial stress becomes overwhelming. Staying engaged with the situation, even when it is uncomfortable, preserves options that disappear once the process has advanced.